Good morning.
Good morning.
It's Monday.
Yeah. Is that what it is? Am I on here?
Little 7-second delay on that. Yeah.
Wait a minute. Am I operating here?
Yes, you're good.
You're good now.
Okay, thank you. Yeah, that's better. It was a delay. Good morning, and thank you all for participating in this morning's hearing. I am Annette Robinson, Chair of the Assembly Standing Committee on Banks. I am joined in the rostrum today by Mr. Fred Thiel, Chair of the Small Business Committee. Unfortunately, Mr. Jeffrey Denowitz, the Chair of the Consumer Affairs and Protection Committee, is unable to join us. He had business in his district. We are also joined by Assemblymember Pichardo and Assemblywoman Hyman. Assemblymember Pichardo is from the Bronx, and Assemblywoman Hyman is from Queens. The Committee on Banks, Small Business, and Consumer Affairs and Protection convened this hearing after a number of witnesses at our hearing last year on small business access to capital talked about how a larger and larger portion of the small business lending market was moving online. We would want to find out what this change means for New York's small business community and to make sure that New York small businesses have fair access to capital at reasonable rates and terms. Before we hear from our witnesses, let me turn to Mr. Thiel and other members in attendance for their opening remarks. Assemblymember Thiel.
Well, thank you, Chairman Robinson. And first of all, it was a pleasure to join with you late last year to have that public hearing on access to capital for small businesses. I'm glad we could join together on that, and I'm happy with today's follow-up hearing, because one of the things that we really heard at that hearing was the increasing prevalence of online lending, and in particular the impact that it is having on small businesses. In particular, perhaps the predatory nature of that, and the fact that it seems to have largely been an area that is unregulated. So this seemed like a fertile area to be following up with additional hearings and additional inquiries. And today I hope that we can get a clear picture of what is going on out there with regard to online lending, the impact that it is having on small businesses, and particularly some of the adverse impacts that we have been hearing about. And then hopefully we can proceed to look at ways that the state can help to protect consumers, protect small businesses from some of the worst practices that are being engaged in. So again, I thank you for taking a leadership role here, and as the chair of the Small Business Committee, we certainly have an equal interest in this and look forward to working with you in the future.
Yes, we do. Thank you, Assemblymember Thiel. Mr. Pichardo?
Is this thing on? All right. Well, first of all, Madam Chair, Mr. Chair, thank you so much, and to my colleague, Assemblywoman Hyman, thank you for joining us this morning. Ladies and gentlemen, we are at the new frontier. The issue of online lending, not only in the small business sector, but in the private online sector, is making a very direct impact on small businesses in particular. Because it's such a new frontier, it's almost to the point where it's the Wild West. And we need to make sure that as legislators and as a government, we need to make sure that we arm our small businesses with the best tools possible to make sure that they make the right decisions for themselves, for their consumer base, and for their workers. I'm proud to join all my colleagues in the State Assembly to make sure that these issues are heard and publicly, and that we get feedback from business leaders, community leaders, and leaders from all aspects to talk about this important issue. And I'm looking forward to hearing from the testimony this morning from our witnesses. Thank you.
Thank you, Mr. Pichardo. Ms. Hyman?
Good morning. As a new member, I'm anxious to hear, listen, and learn from the sectors that make up the state of New York and how this is affecting communities all over, not just Queens, where I represent, but all over New York State. I thank the chairs, Thiel and Robinson, for their leadership, because as a new member, I listen a lot, and I'm learning volumes. And I thank you, Assemblyman Pichardo, for your guidance also on these issues, because I think we have to always remember that small businesses make up so much of New York State, the economic infrastructure that we have. So I'm really excited to learn and listen and see how we can better help serve the constituents and the small business owners who take care of those populations in New York. Thank you.
Thank you so much for your remarks this morning. I do want to say that this has been an ongoing issue. I know with the Banks Committee, this has been an ongoing issue in regards to lending, how it's operating in the state of New York. And so Assemblymember Thiel and I said that we need to look at this more carefully to see how we might be able to strike a balance, because we recognize that people are doing payday lending and other kind of source lending within the state of New York as well. Not only are they doing it in New York State, but they're doing it in all of the cities across this country. So we wanted, for the purposes of this hearing, to hear from you to tell us, what is it that we need to do? How can we make it work better for the people of the state of New York? Thank you so much. With that having been said, I want to thank the staff. Deborah Jenkins was the analyst on the, is that Jenkins? Yeah, okay, thank you. On the Small Business Committee, Brian Williams, the analyst for the Consumer Affairs. Peter Hoffman, of course, my analyst for banks. Kendall Jacobson, committee assistant. Terry Kleinman, the counsel, and Aaron Suggs, assistant for the program and counsel. Assistant, is that secretary? Oh, that's what you wrote? Okay, okay. Secretary for Program and Counsel is different when you're reading someone else's writing. So, okay, so that being said, we will call the first witness.
Okay, our first witness is Patrick McCrell, President and CEO of the New York Business Development Corporation.
Welcome, Mr. McCrell.
Good morning.
Good morning. You may proceed.
Thank you very much, and it's very. Thank you for having me back. I enjoyed our discussion in December, and I'm glad we have the opportunity to continue it. You know, Assemblyman Pichardo likened the online lending scene as the wild, wild west. I beg to differ. In the wild, wild west, both the bad guys and the good guys had guns. Not so much here. My name is Pat McCrell. I'm the President and CEO of New York Business Development Corporation and its affiliated entities. We have 8 offices across New York State and 100 employees that serve small business. We're a privately owned, not for-profit company formed in 1955 by the New York State Legislature under Article 5A of the banking law, which is conveniently called New York Business Development Corporation. The capital to support our lending operations comes from lines of credit that are extended to us from 120 banks in New York State, all of which are determined that we be their representative in making loans to small businesses that can't secure conventional financing. We've been doing that consistently since 1955 and can expect to do it for many, many decades to come. As an alternate lender, our mission is to promote access to capital for New York small businesses that are unable to secure conventional loans on reasonable rates and terms. We make loans to startups, early stage, and mature businesses to support operations and growth. We are active lenders under a variety of state and federally sponsored loan programs and have a managed portfolio of more than $1.3 billion in small business loans. Our loan amounts range in size from $25,000 to $5.5 million, with the vast majority of them being under $300,000. More than 20% of our loans are to startup businesses, and by using that term, I say that that's a business that has had no historic revenue, a true startup business based on projections and a business plan. About the remaining, another 10% are to early stage businesses that would have less than 2 years of operations. More than 30% of our loans are made to women or minority-owned businesses in New York State. Many NYBDC borrowers lack the historical track records and demonstrated cash flows. These borrowers generally possess a higher risk profile than the traditional banking and lending customer. Our expertise in analyzing risk, et cetera, has managed us to have an expanded credit box to serve these small businesses and to promote their access to capital.
Will you pull your microphone a little closer, please?
Yes, ma'am.
Thank you very much.
Unlike a traditional corporation, our enabling statute prescribes the composition of our board of directors. So in addition to directors elected by our shareholders and members, We have members on our board of directors that are appointed by leadership of the New York State Assembly, the New York State Senate, the Governor's Office, and the Commissioner of Economic Development of New York State is also an ex officio member of our board of directors. A rather unusual structure for a for-profit corporation, but that was the statutory direction back in 1955, and we've stayed true to that to today. We recently collaborated, by recently I mean a few years ago, with the New York Bankers Association to form the Small Business Emergency Loan Fund in response to Hurricane Sandy. And we loaned more than $18 million to 797 small businesses in a period of less than 10 months. Our first loan was advanced within a few weeks of the storm, and we continued to advance loans over the following months until the New York State and New York City loan programs, each supported by HUD funds from under the CDBG program, were available. We continue to manage the New York City Emergency Small Business Loan Program, and we've also managed the Small Business Grant Program that was established by the Mayor's Fund to advance the City of New York under Mayor Bloomberg. As a result of our work on the Emergency Loan Fund, we started to explore procedures to support expedited loan processing and funding. Simultaneously with this effort, we began to see an increase in the number of small businesses that were experiencing significant cash flow issues compounded by repayment obligations on loans secured through online lenders. There was a dramatic increase in the number of small businesses approaching us seeking to refinance the online loans in order to improve their cash flow. In many cases, absent some relief, the small business would not be able to continue in operation. The typical borrower has 2 or 3 online loans, each of which costs 30% or more to obtain. Most are of relatively short duration, 6 to 18 months, and require daily payments which are drawn directly from the operating account of the small business. Instead of expressing the cost of borrowing in terms of a readily recognizable interest rate, they're simply reflected in cost. When I refer to cost, I'm not referring to an interest rate. Instead of expressing the cost of borrowing in terms of an interest rate which accrues on an outstanding balance of the loan, as in the case of a typical business bank loan, many online lenders express the cost of borrowing as a fee, which is payable irrespective of when the money is repaid and cannot be avoided by prepayment of the obligation. In a recent case, a small business borrower sought $100,000 from an online lender to purchase equipment for a new business location. The transaction anticipated that the small business would sign a note for $130,000, receive $100,000, and would pay back the sum of $130,000 via daily payments for 18 months. On the surface, this would appear to be an annual interest rate of about 20%, $30,000 for $100,000 for 18 months. However, when you actually calculate the annual percentage rate in accordance with the mechanisms that have been mandated by the federal and state government in accordance with all sorts of consumer protection statutes, the actual annual percentage rate would far exceed that and would be somewhere closer to 50%, not even taking into account any ancillary fees that the business might pay in connection with securing the loan, such as a point on commitment or other closing fees. The small businesses that we work with tend to have fragile income statements and balance sheets which are not able to absorb the cost of capital at that level. We often saw the first online loan as creating the need for a second to fill the holes caused by the debt service on the first online loan, and so on and so on. Oftentimes, our refinance of these loans has resulted in significant cash flow savings to the small business, often thousands of dollars a month. In addition to our traditional efforts to refinance online loans to improve cash flow, we focused on education and the development of a reasonable alternative. My good friend Jim King, who is the director of the New York State Small Business Development Centers, I believe is going to testify following me, so I won't steal his thunder in terms of education, but we've been working with him closely and his centers across the state to provide information and data about these programs so they can reasonably arm and tool their small business advisors, who are often the face and only truly independent professional that many of these small businesses may see in the process. We have similar ongoing discussions with the New York City Small Business Solution Centers, including Commissioner Greg Bishop and his Deputy Commissioner Rachel Van Tosh, who deals with small business lending and the Small Business Solution Centers. So our first route has been in this space is education, because we feel we have a responsibility in accordance and consistent with our mission to make sure that people know the pitfalls that are before them. The second was to provide a reasonable alternative solution. In 2014, we teamed up with a technology partner to develop an online lending program. Our goal was not to become an online lender. Our goal was continue our mission of service to small business through an online lending program. We would continue our primary role as an alternate lender. In addition to developing the technology to meet and serve small businesses online, we also sought to develop a suite of business advisory services which we would make available to the small business with the goal of making the small business credit ready for conventional financing on significantly better rates and terms. The principal view and intention of us going online was to get the borrowers offline. The result was the Smart Loan Program, which is now offered by our CDFI not-for-profit affiliate, the Excelsior Growth Fund. The goal is to provide a reasonable alternative to many small businesses that go online in search of a loan that is decisioned in a fast, transparent, and predictable manner. Once we engage the business online and meet the immediate credit needs, we engage them with business advisory services at no cost to the small business. We have developed a consulting core of accountants, financial professionals, web designers, marketing professionals, and all sorts of other professionals that we pay and engage the business to accelerate its ability to grow and to accelerate the likelihood that it will gain access to conventional capital. Our use of the online program, platform, and decisioning model allows us to process loans quickly and provides the transparency and predictability that small businesses expect in an online program. Importantly, it also helps us deal with another significant issue, which is the failure of the recovery of small business lending to persons of color and ethnic backgrounds throughout the state. The beauty of the online model, the process is blind, absolutely blind to race, color, creed, religion, and all manner of subjective factors that impact the small business's likelihood of getting a loan should they present themselves to a conventional lender. Qualifying applications are automatically approved in less than 2 days, and applications which don't qualify are further reviewed for exception-based approval, and about 30% of our loans are approved on an exception basis. However, the differences between our program and the typical online lending option go well beyond rate and terms. And a key part of that is we have developed a partnership with the New York Bankers Association and the Independent Bankers Association of New York, both of which have endorsed this product. We encourage member banks of those organizations, as does the New York Bankers and the Independent Bankers, to refer small businesses to this program that are unable to secure conventional financing. It may be under second look programs, or it may simply be, as Flushing Savings Bank says, they don't do $100,000 loans, so they simply put our site on their website. The goal is we work with those businesses and then provide them referrals back to their bank of account. The goal is to get them online so we can take them offline. When you get them online, the rate, they pay for rate, speed, and lack of other intricacies of the lending process. When you can show credit performance and move them back into their bank of account, they're generally going to benefit from availability of larger amounts of credit, better interest rates, better terms, and the fact of the matter is most small businesses are better off with a conventional or traditional relationship with a financial institution that can serve their needs going forward, whether it be letters of credit, whether it be lines of credit or otherwise. I thank you for inviting me. I appreciate your patience if you've heard me out on some of these points before, and I'm certainly happy to answer any questions.
Thank you, Mr. McCrell. I will turn to my colleague, Assemblymember Field, but also I'd like to introduce one of our other members has joined us, Ms. Fahey. Assemblywoman Fahey has joined us this morning. Thank you.
Thank you, Mr. McCrell. Thank you for your testimony. I guess my initial question would be, how pervasive is the problem of a small business taking out that first online loan and then suddenly they have to take out a second? How pervasive is that in the marketplace? Can you kind of describe what you think the marketplace looks like right now?
I in all fairness, I can't tell you that. Principally because the ones we see for refinance almost always have 3. That seems to be the magic number. That seems to be the threshold of pain. You borrow the first one, and we always say in the office, you borrow the first one, it's oh boy. You get the second one, it's oh my. And you get the third one, and it's oh, fill in the blank. Because they're borrowing to pay debt service. So the ones that I cannot say that there have been not successful online solutions that have gone exactly as planned. One-time shot, fills the capital hole, gets paid back as agreed, and then they go on and are able to, just continue on after that. The ones we see are in distress.
Well, it sounds to me that sounds a little bit like sometimes what we see in our offices with constituent problems, when almost all hope is lost. And, things are as dark as they can be, they show up on your doorstep if someone is at their, is there a way to, obviously this is outreach, but to get small businesses in touch with, an alternative lender such as yourself before they get a second or a third loan?
What we hope, unfortunately, most of the, and we're learning a little bit of this as we go as well because it is a new frontier, most of our referrals historically have come from banks, credit unions, small business development centers, New York City business solution centers. And generally the businesses that are going online are going there first, right? When you think about the typical, when I in my mind, when I conjure up the typical small business person going online, it's not the person who you hear on the Bloomberg radio that says, they wanted $100,000 and all of a sudden their restaurant improved by 50%. It's a person sweating on a Thursday night or a Friday night. He has a sales tax installment due. He has a FICA FUTA payment due. He has some other obligation that's coming due that unless it's paid, whether it's rent or otherwise, it's going to have a significant and immediate impact on the business. The person, the business owner, has worked 12, 14, 15 hours that day, is home at their computer. They're trying to figure out how to work their way out of this mess. That's the one I see. And unfortunately, we don't get that opportunity to intervene. Maybe at some stage, as we continue to work on all sorts of web prioritization issues, as we try to get our face higher up in the web hierarchy so that we're able to get them on the first page. But I doubt that's going to happen because I don't have the hundreds of millions of dollars that are able to get me into that web optimization space. So we have to rely largely on education. And I think that the important part of that, we have to rely, I think, on legislative assistance to provide disclosures, to redirect, take the opportunity to redirect those people, just to stop and pause. When there were issues relative to home refinance, somebody stopped in and said, okay, we're going to have a 3-day waiting period, so you can sort of sit down, you can get this done, but you're going to have to sit down and sort of wait it out and see how you feel about this tomorrow morning when the sun rises and you're well rested and things are going forward. So I think the issues that we have here, and I included in the materials a loan that we just closed a couple of weeks ago where a woman said we saved her business because she was going down that path, and it was a very successful business, and it just had cascaded into something she couldn't handle. So I'm not entirely, the use of the term 30%, when somebody sees 30% and translate that in your mind as an APR, and you translate that into maybe say, if I got a credit card, I'd be paying 30% or 28% or 29% or whatever it was. But if that's quickly translated into an APR in the consumer's mind, and without a realization that APR, that's not an APR, it's a cost. And when you translate that cost into an APR, you're doing something dramatically different. So if you looked at a cabbage calculator, for instance, it would say that there's a risk yield of 3%. That translates into an interest rate of 32.46%. But in my mind, I'm seeing 3%. When I see 30%, I equate that with what I would immediately do under my small business, but with my revolving credit card balance. But the difference is I can pay that off early and avoid that cost. I can rent that money at that price. I don't have to buy it at that price. And when you're going online, you're buying the money at that price, and there's no returning it. When you go in a traditional lending environment, you rent the money, And when you return it, the rent is done.
I mean, you're describing people that are in some degree of desperation. That's the picture that you paint. And obviously, you know, in that kind of situation, you know, people make bad decisions. And you've described what you and your role can do as far as education and providing an alternative. What do you see as you mentioned one, you know, a waiting period, but I guess first, what do you see as possible legislative solutions to protect consumers? Are there other states that are doing this better than we are? And is it, third would be, you know, given the nature of it being online, what's the role of the state versus, say, the role of the federal government? What does the state have a role?
Well, you know, I
think questions in there.
Yeah,
I know,
although I made the analogy to the waiting period in the mortgage refinance, you know, it sort of seems that it probably wouldn't be a good solution for people seeking speed, transparency, and predictability. I mean, I'm decisioning a loan in 2 days and funding in 5, so if I had them wait 3, it probably wouldn't be very. It would probably defeat the purpose of the program, or at least water it down. Requiring very, I mean, and trying to get your questions in order that you asked them. Requiring, you know, from a legislative matter, I think requiring disclosures onto annual percentage rates or making equivalent calculations to annual percentage rates would be a very effective information tool to the borrower. Then those terms can be, you know, it's America. People get to do stupid things, whether you want to protect them against it or not, right? But the reality is that knowledge and information, the ability to compare fairly among alternatives is a valid area for government, I think, to intervene in this. And making those analogies to tracking those costs, I mean, they can still express, I would have no objection to them continuing to express it in a cost basis, but they should make an equivalent comparison to what it is to what the equivalent APR would be factored in. And that would be a relatively easy aspect to do. As far as other legislation, this is, New York State is right where everyone else is on this. Everyone is studying this because what happened is when online lending came out, it was the grand panacea. Everyone was saying, oh, isn't this terrific? Businesses can go online, they can get money, you know, they can do all these things. And unfortunately, that became true. And what's happened is we're only seeing the cascading effect of this come in the last year or so. Legislators, bankers, small business advocates are standing up and saying, and if you look at the newspapers and financial journals that heralded the arrival of the online lending space is now looking at it and saying, oh my God, what have we done? All right, and look at the online lenders, the value of their stock, how that's happened in the market as people have started to say there is a price to pay for this, and absent this kind of disclosures and ongoing. You know, the ability for the consumer, whether it's a business owner or an individual, to evaluate fairly what they're receiving in that space is something, you know, that's very significant. And I think finally your last question was what's going on at the federal level. And I don't know what, I suspect the consumer CPBB, whatever the proper acronym is, I suspect they'll be active in this because they've indicated an intention to be active in lots of different things that don't just involve consumers. So I do expect this to be something at the federal level. I know I've participated in a number of events at the Federal Reserve, both in New York and in Washington, that is looking very closely at the online space and trying to sort out, you know, who's getting disadvantaged and how they can be protected.
Okay. Thank you.
Thank you, sir.
Mr. Pichardo?
Thank you, Madam Chair and Mr. Chair. So the rise of online lending, it's just an issue of convenience and the fact that you can have such a quick turnaround if you're in a desperate situation. So just flipping that on its head, what typically is the issue with brick and mortar? Is it the fact that it just takes too long to access a loan, or the fact that it's just as inaccessible, it's less accessible to get a brick and mortar loan than it would be to get an online loan? I'm not sure if I'm clear.
No, you're very clear.
Okay.
Just the best way to frame my response to that. You know, I think the Federal Reserve produced some data that the average small business loan application took 24 man-hours to complete. The average small business loan application online, well, I don't know what the average is. I can tell you what the average amount of time it takes to complete our online application is 20 minutes. The average decision time on conventional small business lending, and this is, from all sources, and, there are a lot of banks in New York that do it faster. There's a lot of banks that do it slower, and there's some that are more responsive than others. But then once the loan is approved or decisioned, the funding process, again, is also, a delayed process. So, and I think lastly, and this is a dynamic that's nationwide, is that there are built-in prejudices to traditional lending systems that are not apparent in the online process. So I think that, we've done a number of discussion groups in and around New York City with thought leaders who I know and respect in communities, Upper Manhattan and Jamaica, where we've discovered that despite the best efforts in outreach, there remains a residual reluctance of minority-owned small businesses to approach conventional lending for a response.
So I'm glad you brought that issue up, because my question turns to this, which is there a disparity between small businesses of color and just the whole overarching scheme? Is there a discrepancy in terms of, do these small businesses get in more trouble with online lending, or are they sort of in the same average as every other small business across the board? Are they more subject to victimization through the online lending process?
I can't say.
Okay. Thank you.
You're welcome.
Ms. Hyman?
Thank you. So you said that 30% of the $1.3 billion that your company generates are from minority and women-owned businesses. Is that self-identified businesses, or do you verify that these businesses have that makeup?
We see them all in person.
You see them all in person? Oh, okay. Thank you.
You're
That was
welcome.
it.
Thank you. Ms. Fahey?
So it's verified.
If you don't have a question, you can make a comment. Ms.
Yeah,
Fahey.
thank you. This was very informative.
Certainly.
I can't tell. Yes, it's on. Could you just give us a little bit more, though, on disclosure when Mr. Thiel asked if, what can we do? And so are you saying that there's just no requirement on the part of online lenders now that they have to, or is it buried in fine print somewhere that is just not being paid attention to? And would disclosure be sufficient, more disclosure about the final rates? Is that enough? If you could just elaborate a little bit more on that. And thank you, this is very enlightening.
Based on my understanding, there is no current requirement to make any sort of comparisons to an APR or express the cost of that capital.
I'm sorry.
Based on my understanding of the current requirements, there is no requirement to express the cost of that capital in terms of a traditionally accepted APR. So the extent you can go and buy a used car for $5,000 and finance it, you're going to get an elaborate disclosure of the actual cost. There's no such, disclosure here in terms of an APR. It's expressed as a cost. Because quite frankly, if it was expressed as an interest rate, it would likely be illegal. Usury. It would likely be usury in many cases. So the idea of expressing it as a cost, in other words, they're buying the capital, not renting it, is something that I don't think the average business consumer understands. I don't think the average business consumer understands that if they can repay it early, they will avoid all or some of the cost. And that's not the case. So, there is a fine line between mandating intelligence and preventing and which might cause you to avoid the online space or certain online lenders, and making sure that they can make informed choices about that. And I think making informed choices is the idea of mandating an expression of an APR, because I think simply mandating the expression of an APR will scare the bejeebers out of some people. they'll look at those numbers and say, wait a second, something's wrong here. I shouldn't be paying 49% or 50% to borrow money. And when they start thinking about, when you think as we do as small business lenders, and we look at in businesses with very fragile balance sheets, if you add $100,000 to the asset side and you add $130,000 to the liability side, you can't do that very often and have a sustainable business. And what happens is they get to the second and third online loan, and even the online lenders won't lend the money then, and they're struggling. So the issue here is really, as I said, you can't mandate intelligence, but you can mandate an understanding of that and how these things are disclosed. And our position would be that would be a viable and valuable effort in terms of safeguarding small businesses in terms of their choices for capital.
Thank you. Mr. McCrell, you indicated, you suggested that perhaps how we as legislators might be able to be helpful. And I was thinking about that. Do you have a relationship with the chambers of commerce across the state?
I would not say we have relations with chambers of commerce across the state. We have relationships with many chambers of commerce. We found them to be they're more effective in some regions of the state than others, candidly. And those that we found have been effectively interacting with their small business members. We are members and active in those chambers, and others we are not. For instance, when you take the Hispanic Chamber of Queens, the Hispanic Chamber of Brooklyn, the New York City Chamber, the Queens Chamber, we are active in those and do seek to I don't want to use the word proselytize, but that's what I intend to the membership about issues related to access to capital.
But is there an active? I'm thinking through in terms of if those kinds of entities exist, that perhaps there might be some kind of a relationship and an educational program that would go on as part of that to be able to help small businesses. Because in the one that, of course, I know Brooklyn quite well. And I know that they do meetings from time to time, and I'm just thinking that they would be able to help people to be able to understand what it means if they go on an online lending, or to let them know of the risks that are inherent within that process.
Well, that's a very good observation, Madam Assemblywoman. We just did Carlos at the Brooklyn Chamber is a very good friend of mine, and we just did an event with the Brooklyn Chamber a week before last, which highlighted, we had about 60 businesses present, and highlighted various sources of capital. We had representatives from the Small Business Development Center and a variety of other local people to highlight the pitfalls and the opportunities in the small business, the alternate space. So those are very valuable. And the Brooklyn Chamber, quite frankly, is pretty unique in terms of its proactivity in favor of its membership in that regard.
Yeah. Because I'm thinking also there's also a program called Chamber on the Go. And for those businesses that perhaps do not get out to those meetings, that the Chamber on the Go, that has a van with staff on it, to be able to go out to those smaller businesses to advise them, those that are struggling, that don't know about your services. So I'm just thinking that how we might be able to expand that somehow.
Yeah. One of the areas that, we have been, one of the areas that has been very good for us is, we recently did a 3-part financial education program in Nassau County, actually eastern Nassau County, with the goal of, once again, familiarizing businesses with these. And that was sort of our beta test for that, because we developed a 3-part curriculum for that. We're next going to offer it in Buffalo and take that through the state. We're very focused on, through this CDFI, the CDFI, its core mission is LMI communities and small businesses owned by persons of color. That's the LMI focus. And so we're focusing on in developing educational materials around that, in addition to our overarching, need to get through the state and to make this program a viable one. So we are focused on that quite well and are looking for every resource to sort of spread the word.
Thank you. Are there any other questions? Okay. Thank you so very much.
Thanks very much for having
testimony.
me.
Thank you.
Okay.
Good luck getting out of the building today with all of the political activities
Yes, that's right.
in the neighborhood.
We're political captivity. Yes, it is. Yeah. I'd like to acknowledge the presence of Mr. Santa Barbara, Assemblymember Santa Barbara.